Let's dive into our first presentation on finance from Wormtown Brewery CFO Kary Shumway. Kary is, as I mentioned, the CFO of Wormtown. But in addition to that, he runs the beer business finance and craft brewery finance online resources for beer industry professionals. He's worked in the beer industry for more than 20 years as a certified public accountant and a chief financial officer for a beer distributor. So, Kary, I'm looking for you somewhere around here. There you are. Come on up. You're hiding.
I'm Kary Shumway. I'm a CPA, CFO, numbers guy. And I spent my career, started as a CPA, tax returns, audits, all that fun stuff, and transitioned to a beer wholesaler where I worked as CFO for about 15 years. And during that time, we acquired a number of companies across 3 states, and we had about 2,500 SKUs that we were managing and distributing. So got to know the distribution side of the business really well. We sold those businesses off about 1.5 years ago, and then we joined as partners at Wormtown Brewery in Worcester, Massachusetts, where I'm at right now as CFO and a partner. I founded craft brewery finance and beer business finance mostly to share what I've learned so I can shorten the learning curve for other craft breweries, help you become more successful. You go through your day-to-day and you learn stuff, and I happen to just forget these days, so I write a lot down. So I figured I'm going to write it down, share it, and see if it's useful for other people. So if you want to check out the resources, you can go to those websites. And also, I'm going to be covering, there's going to be a lot of spreadsheets on here. Some of it can be a little bit dense, so I'm going to have downloads available. So if you go to Craft Brewery Finance, there'll be a download there. You can grab all the spreadsheets there. And if there's questions after, I'll have my email. You can shoot that to me. So when Chris was kind of teeing me up for this presentation, he hit me with a lot of bullet points. Let's talk about this, let's talk about that, and talk about the other thing. And I'm writing notes. I'm like, good Lord, how am I going to? So basically, he concluded by saying you have 30 minutes to make everyone better financial operators. So, challenge is accepted. I accept that challenge. So what does that mean to be a better financial operator? It means the basic things. You have to have good financial systems and process and procedures and so forth. But really what I like to emphasize is keep it simple. I like to create routines so you're actually going to look at the numbers. So I've created a lot of financial statements, done a lot of tax returns, and I'm excited about it, and I bring it up to the owner of the business or whomever, and they're like, they don't even look at it. So it's kind of demoralizing. So what I've been focusing on with craft brewery finance specifically is try to keep it simple. So create routines so that you're actually going to look at the numbers. So use simple scorecards, use KPIs, key performance indicators. So the takeaway is, have something that you're actually going to use, that you're actually going to look at, not like a 20-page set of financial statements that you really have no interest in looking at. So the purpose of the information is obviously so you can make better decisions and create better financial results. So if you only remember one thing from this presentation, that is create a routine to pay attention to your finances and specifically your cash flow. Because we all focus on our day-to-day stuff. We got to make great beer, great customer service, quality, safety, all that good stuff. These are all very important, but ultimately cash flow is what's going to keep us in business. And I think we've seen that recently in the news, and it's going to happen more. It's just when you don't pay attention to cash flow and you run out, you're out of business. It's as simple as that. So keep it simple, create some simple scorecards, and I'll share some of those in the presentation. So what I'm going to talk about specifically are 3 stages of brewery growth: early stage, growth stage, and then long-term, and ultimately what growth looks like on the financial statement. So obviously we know if we're growing, there's different ways to finance that, but typically if we're going to borrow money, it's putting liabilities on the balance sheet. There's going to be requirements from the bank that we need to pay attention to. So early stage, looking at capital allocation, managing cash. Growth stage, when or if to continue growing and how to raise money to expand. And then looking at some long-term valuation situations. So decisions that we make today and how it can ultimately impact your value. I have a fun spreadsheet on that I think you'll enjoy. And then lastly, we'll conclude with 3 financial models. We'll look at, typically our breweries are either traditional breweries going through third-party wholesalers, or we have hybrid models where there's some self-distribution and use of third-party wholesalers, and then direct-to-consumer, which is tap room and self-distribution. So the financials look different at each stage depending on what type of brewery you are. So in the early stage, when you're just getting going, your primary considerations, get the money, get the doors open, don't run out of cash immediately. So I typically recommend two, at a minimum, these two schedules that you'll want to look at or create for yourself so you'll have some financial roadmaps to work. The first is a sources and uses schedule, and the second is a simple cash flow schedule. So sources and uses schedule is kind of a banking term. They want to know sources, where you're going to get the money from, and uses, what you're going to use the money for. And ultimately, it's going to create a capital allocation roadmap for you so you can determine, all right, how much is this project going to cost? Where am I going to get the money? How am I going to pay it back? And then what am I going to use it for? A cash flow schedule, how many people in this, do you guys use cash flow schedules? Okay, one. So it's two. So it is rare. I mean, income statement's typically what we look at, but cash flow is obviously really important. So we're going to look at a simple cash flow statement that you can use that's going to focus on the three areas where cash tends to get consumed. We look at the net income and the income statement. That's not cash flow. So we need to adjust for certain things that aren't showing up there. So we'll look at that in the cash flow schedule. So this is a simple sources and uses schedule. It's really just going to kind of outline on the left-hand side what we have for sources. We have $1 million brewery project in this example, and where are we going to get the money from? In this example, we're going to have equity investments, shareholder loans, and some bank loans, totaling up to $1 million. On the right-hand side, we have our uses. So where's the money going to go to? So brewery equipment, installation, construction, tap room, restaurant, if we're going to have food, legal and org costs, and don't forget the working capital. That's the money in the bank that's going to cover any shortfalls in your day-to-day. So the basic equation is sources are going to have to equal uses. Where am I going to get the money? How much is it going to be? And where am I going to spend it? So it's pretty straightforward. It's pretty easy to have. Doesn't take too long, but it can be a very useful tool. And if you go to borrow money from the bank, they're going to want to see this. So it demonstrates that you've given some consideration to how much the project is going to cost, where you're going to get the money from. You have an understanding that the bank is going to want you to put some cash in, equity and so forth. Typically, these will be all over the place, but a bank's typically going to loan you 70 to 80% of the project costs. They're not going to give you 100%. There's other creative ways to do it, but typically you want to plan on 20 to 30% of your own money going in on the project. So this is a simple cash flow schedule. Very simple, probably too simple, but it gets the point across is when we look at net income and we look at cash flow, they're very different things. So in this example, I'm pulling net income from our income statement, 25 grand. Hey, we made 25 grand this month. That's great. Then we look at the bank statement. There's nothing in the bank. What's going on? So creating a simple schedule like this to monitor your cash flow items outside of just your income can be helpful. Again, it's a starting point. Maybe it'll be a gateway financial statement to get you to a full-on cash flow. But you start with your net income, and you're going to subtract certain things that affect cash flow that aren't represented on your income statement. So principal that's paid on your debt, the interest expense is included in your net income, but the principal portion of that payment's not. Fixed assets that we pay for in cash, it happens. Typically we try to finance those things, but if we're paying for them in cash, that's not affecting your net income. And any increases in some of your balance sheet items, specifically accounts receivable and inventory. So one takeaway is that as you, any breweries in here that are growing like crazy? Anyone? No? One, couple. So one thing that growth does, that if you're in that mode, you know it, but if you're anticipating getting into a growth mode, one thing growth does is it consumes cash like crazy, right? And some of the ways that it consumes it are on the balance sheet. So they're not on the income statement. So if we're only looking at the income statement, feel like we're doing pretty good, but we got to look at the balance sheet as well. And this is a simple way to just look at a few aspects. And in particular, what I see as an increase in accounts receivable and increase in inventory can really consume a lot of cash. So sales are going up. You got to have more inventory, raw materials, packaging, finished goods, and accounts receivable, particularly if you're self-distributing. Retailers, I don't know why it is. They don't always pay on time. And sometimes they don't pay at all. So you've got growth in these assets that your net income thinks is there, but your cash flow says it isn't. So simple cash flow statement. really important to do. So 3 buckets of where cash goes are hard assets. To schedule that out, we want to take a deeper look at our usage schedule and do a capital expense plan. So basically what we're looking at is what kind of brewing equipment, if we're going to get into self-distribution, what kind of assets are we going to need there? And obviously taproom fit-up if we're in that business. The capital expense plan is going to just be a more detailed listing, what you're going to buy, specifically what's it going to cost and when are you going to pay for it. An operating expense plan, your day-to-day expenses, your payroll, your lights, your heat, your power, your lease expense. So an operating expense plan there is obviously important. And then again, these hidden cash flow items, they're really not hidden, they're just on the balance sheet, which doesn't get a whole lot of attention. But looking at your balance sheet, inventory, accounts receivable, principal on debt in particular. So you can cover all of these things, and I certainly recommend that you try it with a full financial pro forma. So capital expense plan, operating expense plan, and looking at your balance sheet. But if you're not ready for that, the simple cash flow statement should get you started. So next we'll look at growth stage, basically when to raise or if to raise and how to raise. So the when to raise is going to be dependent on, I think primarily it's going to be dependent on your risk tolerance. How much debt do you want to take on? How confident are you in the continued growth of your brands? What's the market demand? What trends are you seeing? If you're working with a wholesaler, what are they saying? If you've got taproom, what are your consumers saying? So you're trying to cull all of this information and determine, is the market demand really there? And if I borrow this additional money, and I put this risk on my business, is it going to pay off? It's the fundamental question in the growth stage is when do I do it? But the alternative is if you want to do it at all, because there are a number of breweries that, they stay small. We know taproom and local self-distribution can be a very profitable model. So Little Giant staying small and profitable. At Wormtown, we looked at our brands, and our strategy is really see how far we can take the brand. So we're willing to take on the debt, we're willing to take on some risk in order to continue to grow, but hopefully do it in a methodical fashion. So when to raise is I think, primarily based on those factors. How to raise, there's a number of ways, but three primary ways. One is growing with cash flow. So basically, financing your own growth internally. This does make me happy. I don't know if it makes anyone else happy, but that's one way that you can obviously grow. It's difficult to do. Cash flow doesn't come easy, certainly in the beginning stages, but it is an option if you're willing to be patient and focus on it. Obviously do a second raise with friends or family or outside investors, and then raising through bank financing. And that's what I'm going to dig into a little bit here in terms of sharing with you a little bit of how bankers think and what they're going to ultimately need from you. So the 5 C's, this is a little bit dated, but banks will use these 5 C's to determine essentially whether they're going to loan you the money. So capacity, capital, collateral, conditions, and character. So with capacity, they're really just, the fundamental question is, can you pay the money back? And exactly how are you going to do it? So next we'll look at a pro forma that'll help you demonstrate to the bank, all right, here's what we project to do, here's how I'm going to pay the money back. So capacity, typically that's number 1. Capital, how much skin do you have in the game? This has happened to me time and again where you try to borrow 100%, and you can do it, but the bank's always like, well, how much equity are you putting in? How much equity is your company putting in? They want to make sure that you're invested financially, emotionally, and then ultimately you believe in the project. And cash on the barrelhead it demonstrates that to them. Collateral. These guys are always, my experience, thinking of the worst case scenario. What happens if your door closes tomorrow? How do I get at my assets? What do you have for collateral? They're unbelievable. So they do love that stuff. And they're probably also going to look for personal guarantees from your ownership group. Conditions, basically, what is the craft beer market? What are the financial and economic conditions globally, not just in your market, but craft beer in general. So they're going to dig in, they're going to ask some questions, they're going to ask you guys some probing questions to make sure you really understand your business and you've considered the financial and economic factors that can impact your ability to pay them back their money. And one thing I would say here on a positive note is the bankers can be really good business partners. I think that we tend to look at a banker as the guy who's going to hopefully give me money, and they only lend money to people that don't need it, and that can be true. But primarily, they're really good business partners. And if you kind of let them into, even if you're in the early stages or you're thinking about growth, if you let them in to your dream and what you're trying to create, they can be really helpful in advocating for you. So that leads to character and relationships. Relationships really do matter. So build that relationship with your banker, dust off your golf clubs, go out for that club sandwich, and get to know them. And obviously, if you can do so, get to know them before you actually need the money, because it really does make a difference. All right, so here's what a snapshot of what bankers are going to need from you in terms of a financial pro forma. Really what they're looking for is a realistic roadmap to pay them back, with an emphasis on the word realistic. So on the left side, we have a summarized income statement, sales through net income, and then we're going to add in our friend EBITDA. So EBITDA is earnings before interest, taxes, depreciation, and amortization. Investors and bankers love this word. Accountants like myself think, well, it doesn't really mean a whole lot, but it's useful for these guys in establishing a modified version of cash flow. So they will likely ask you for it. So it's good to know what it is and how to calculate it. And again, trying to keep it simple, we're going to take our net income. So EBITDA, earnings, is the same as net income. So we're going to take net income and we're going to add back these items that are essentially non-cash, more or less, items that are in your income statement. And that's going to arrive at our EBITDA number. So here, all we're trying to demonstrate is EBITDA, the banker looks at as a form of cash flow compared to the loan payment, the amount that you need to pay them back. And they obviously want to make sure that the cash flow, EBITDA, is greater than the loan payment. So if you can demonstrate it, number one, that you understand the language of the banker, and two, that you can make these numbers look good, realistic, again, being the operative word. If we go over to the total there, we've got about $200,000 plus of EBITDA, and we've got about $90,000 worth of debt payments that we're going to make. Bankers are going to want, depending on all sorts of other factors, they're going to want that to be somewhere in the 1.5 to 2 times range. So just call it 2 times as much cash in as cash out. And that'll vary, but generally the higher, the better. So let's look at long-term valuation. So we've got through early stage and growth stage, and now we're at long-term valuation. So what is ultimately going to drive the value of your brewery? So it's definitely going to be in the eye of the beholder. Different buyers have different needs and are going to assign different values to it. But ultimately, the purest measure of value of any company, whether it's a brewery or you're making widgets, is how much cash the business can generate. And another way of looking at that is how much EBITDA the business can generate. So generally, and a simple way to check your valuation is to measure and track your EBITDA and then apply a multiple to it. So a buyer may come in and they're going to look at your financial statements, they're looking at your EBITDA, and they're going to apply a multiple. Maybe it's 5 times, 7 times, 10 times. So I'll show you a quick spreadsheet how you can have, you yourself at home can have fun with EBITDA. And I do this all the time, and I'm not proud of it, but I do. So basically, this looks familiar. We have our summary income statement, sales through net income. We're doing our EBITDA calculation. But the fancy thing we're adding in here is a multiplier at the bottom. So what we're going to be looking at is what is our EBITDA, what is our projected growth on our EBITDA, and then we're going to apply some multiples. So the multiples are essentially a way to arrive at value. So in the 2018 example, we got about $200,000 of EBITDA, and at a 5 times multiple, that tells us the brewery's worth about $1 million. At a 10 times multiple, it's worth about $2.2 million. And as EBITDA grows, you can see that the valuation is going to grow. It's not perfect. Different buyers are going to need different things. The multiple or the multiplier is going to be dependent on a variety of factors. You know, your brand growth, what's your trends look like, what's your upside in terms of additional expansion, brand strength. There's a whole host of things. So that's the variable. But for sure, one thing you can control and should focus on and should track if you're interested in the valuation of your brewery is that EBITDA number. So recapping early stage, growth stage, and long-term valuation. So in your early stage, do that sources and uses schedule, even if you're already up and running, just to see what are you looking at in terms of what do we have for money, what are we going to allocate it towards. And then that one thing you remember, set a routine to monitor your finances, to monitor your cash flow, and you can use that simple schedule to start with. Growth stages, really making the decision when to grow, if to grow, and understanding how your banker thinks, what makes them tick, throwing out some of those buzzwords every now and again. You talking EBITDA with them, So really understanding what they're going to need from you and what that financial pro forma will look like. And then your long-term valuation, the decisions that you make today and how that's going to impact it. EBITDA growth is good, track it, grow it. Now we're going to get into the fun stuff, the spreadsheets. All right, so we have 3 financial models that we're going to talk about: traditional brewery, hybrid brewery, and direct-to-consumer, and looking at the financial considerations of each of these. And basically what we want to know is, what does growth look like on the financial statements for each of these types of breweries at different levels of growth. So first, our traditional brewery, we're only going through wholesalers. We might have some tap room, but there's no self-distribution. Pros and cons, your exclusive focus and all of your capital, for the most part, can be focused on your being a production brewery, investing in your brewing equipment, quality, capacity. You're leveraging the size, scale, and infrastructure of the wholesaler to grow the sales of your brands. And this is really what we do at Wormtown. We did have self-distribution. We're not in that anymore. We're entirely with third-party distributors, and that's our primary focus. We do have a small tap room, but our focus is on leveraging the infrastructure of the wholesaler, focusing our capital on our own production brewery. So how does growth and new capital impact the financials of a traditional brewery? So on the left-hand side, again, we have our summary income statement, sales through net income. We've got our EBITDA calculation, and then we're going to compare it to our loan payments. And at the bottom, I'm adding in a summary balance sheet. So this is really as simple as an income statement and balance sheet. EBITDA calculation is as complicated as you need it to be. You can always make it more complicated, but starting simple with something like this. So the takeaways from this, I've added in 2 ratios that the bank is generally going to want to see when you borrow money. So one is a debt service ratio, and the other is a debt to equity ratio. So the bank's going to call these ratios, they're also going to likely call them covenants, and covenants are promises, and you don't break promises to the bank or bad things happen. So in addition to the promise of, I will pay you back, they're going to want 2 promises from you in the form of debt service ratio and debt to equity. So the way these things work is, for your debt service ratio, we're looking at our EBITDA, which is essentially our cash that's coming in, and we're looking at our loan payments, which is essentially cash going out to the bank, and we're doing some math on that. So basically the way the math works is we're dividing the amount of money out, our loan payments, into the amount of money in, and that's giving us a debt service ratio of, in this example, 2.7 times. So basically that's saying we have enough cash coming in, we have 2.7 times as much cash coming in as we do going out in order to cover it. That makes the bank happy. Again, they want you to be north of two times coverage or thereabouts. On your assets, this is really a leverage ratio. It's how well you're using debt. They're going to look at some version of a debt to equity ratio. So here we're looking at liabilities and equity. So basically we're dividing the equity into your liabilities number to get to the relationship between how much debt you have to how much equity you have. And here again, the banks are going to, the smaller the better. So 2 times, generally 1.5 times or smaller is what a bank's going to want to see for that ratio. So it can get involved, and I don't want to overwhelm our non-numbers friends in the audience, but I think the takeaway here is, if you create a schedule like this and you understand what the bank is going to want from you and how these calculations work, you're going to be way ahead of the game in terms of when you need to borrow money, when you need to borrow additional money. So how does growth impact these numbers and these ratios? These numbers are pretty much could depend on so many different variables: your sales, your margins, your operating expenses, what your debt looks like, a higher interest rate, how much you're borrowing. But generally speaking, as you're going to grow, and in our traditional brewery model, you're going to need to add more assets. So if you're going to go from a 5,000 barrel brewery to a 10,000 barrel plus, you're going to need more tanks and maybe packaging lines and so forth, so you're going to need to borrow money. So you'll see in this example, our liabilities go from $750,000 to almost $2 million to get us to that larger scale. Our loan payments go from $90,000 a year to almost $250,000 a year. So the point of all this is to demonstrate, not only to the bank, but to ourselves, that as we grow, we're able to pay this back. And that's what this schedule does, is what is our projected EBITDA, what is our borrowings to get to the levels of growth that we want to get to, and then doing our calculations and making sure that we're going to be not running into a problem. So the hybrid brewery is basically that brewery that's doing some maybe local self-distribution, and also leveraging wholesalers outside of their local market. So here we're going to be taking our capital and we're going to be allocating essentially across two different businesses. So we've got our production brewery, we got to make beer to satisfy our distribution market as well as the markets for the wholesalers. And we're going to have to allocate capital, obviously, towards the brewery and then towards the self-distribution assets, trucks, and so forth. So the other component of this is really managing two different businesses. That's what certainly we found, and I think others have found, is that it's a self-distribution business is quite a bit different than running a brewery. Requires different skill sets, certainly different assets, different personnel types. And an example of this is Mayflower Brewing in Massachusetts. They've got a tight local self-distribution territory, and then they use wholesalers outside of that. And this model works very well for them. So the key takeaway here is to really separate the financials for these different operations. So your wholesale operation, those that you're selling to distributors, and your self-distribution operation, so that you can manage and understand how each business is performing separately. So again, summary income statement, what growth might look like. The numbers here are less important than the model that you can use. So here I've just combined in our EBITDA calculation the two operations and used the same type of concept where we're going to look at EBITDA, we're going to look at loan payments, calculate our debt service ratio, and look at our debt to equity ratio. So the math all stays the same. The only difference might be that in your liability section, you may have to borrow more money because now you're allocating assets towards self-distribution in addition to your brewery. Direct to consumer, this is obviously very popular right now, is self-distributing and taproom only. So you're capturing the retail dollar, you're capturing the distributor gross margin, but now you've created essentially a third business line. So you're running a retail storefront through your taproom, self-distribution, and in addition to your production brewery. An example of this is Night Shift Brewing. They do only taproom self-distribution. They do sell other beer brands other than their own to fill the trucks, because that's a consideration as well, as it's hard to kind of get that volume and that economies of scale as you try to build up your self-distribution business. So here again, we want to separate the operations from taproom and self-distro, do our income statement summary, and then look at what growth, how growth impacts the financial statements. And then here summarizing, again, our EBITDA, comparing it to our loan payments, calculating our debt service ratio. Now in this example, the numbers look pretty good because we've got pretty good profitability coming out of that taproom. A lot of this is contingent upon can you grow? So can you grow through the taproom? Can you grow your self-distribution business? And if you can, it obviously can be a very profitable business. But again, you're allocating your capital across three different businesses under this scenario. So key takeaways here, if we have different models, we have different costs, we have different considerations. We want to separate the numbers from each of those businesses to make sure we know how we're doing in each one. Projecting our cash flow, understanding what the bank's going to require from us in terms of covenants, how those calculations work, focusing on these EBITDA and our ratios for the bank, debt service coverage, and debt to equity. So I threw a lot out there, and if there's questions, comments, feedback, you can hit me via email, or I have a minute 53 if you want to ask me questions now. Again, if you go to Craft Brewery Finance, there's all of these spreadsheets will be there with some explanation, a little more detail on how you can use them in your brewery. So you just click in the download section there. So any questions?
Awesome. Round of applause for Kary.
Thank you.
All right, so we got time for maybe one or two questions if you guys have them. I guess my question for you is you showed the sort of three different brewery models. If you were forced to pick one today, what would you pick?
Well, I think you can. I would pick probably taproom self-distribution to start because it's the easiest. You get your hands around it, you control it. You do get the retailer margin, the gross profit margin on distribution. And I think that's generally the trajectory that smaller breweries are starting with. Start as small, taproom only, build up some cash flow, get some pull on their brands. Then they, the local market may want to do some local self-distribution, learn whether that works or not, and then you can transition into. And other breweries do what we did at Wormtown, which is we grew a self-distribution business, and then we were able to transition that to a third-party wholesaler. So we learned a lot in the market, and then it was time to let the wholesaler do what they do best. So.
Awesome. Are there any other questions out there? All right, well, find Kary if you do, and all these presentations will be made available after the crash course. So I saw some people taking some photos. We'll be emailing you guys all these presentations. Thank you, Kary. Appreciate it. Cheers.